Good evening, and today is December the 15th, 2024, and welcome to another episode of the Weekly Market Wrap. My name is Daniel Ang, and before we begin, I would like to acknowledge IronFX for sponsoring this event as usual. For the past few months, IronFX, a broker with presence in over 180 countries, has been sponsoring my weekly presentation, and I just want to acknowledge them. And of course, I have a disclaimer here. And this presentation is definitely not an offer to buy or sell any kind of securities, be it FX or CFDs, and must not be construed to be investment advice. And the trading of any kind of leverage products do carry risk, so do understand your own risk profile before you attempt to trade any kind of margin products. And I'll be sharing you my views, and those are my views, as it got nothing to do with the sponsor. And collectively, we are both not responsible for any action that you may take as a result of attending this presentation. And the content of what I'm going to show you this evening has not been vetted by any regulatory body. Just be aware of this. And let's get started. This week has been pretty volatile. We can see that the prices we of course will begin with the usual economic data that has been released over the past week itself. First off the bat, we have Japan. Oh, sorry. Again, the the headlines is a bit misleading here. So we have the GDP here, we have the Australian GDP here. We can see that we have shrunk from 0.7% in Q2 now to 0.3. So definitely we are seeing Japan, in Australia, the economy is definitely on the back foot, okay? Now, this is definitely a lot better than market expected, because the market was only expecting a 0.2, so it came in at 0.3. So China CPI numbers came in also this early part of the week itself. You can see the year-over-year CPI numbers for China came in at 0.2. So we are still seeing that this inflation going on since the middle of the year itself. So we can see that from a high of 0.6, we are now at 0.2. So definitely prices are moving backwards, suggesting there is a bit of a deflation going on in Chinese economy. So this is definitely not a good sign, because this past week we have seen the Politburo announcing or promising to roll out more stimulus package. So I think they are getting ready for the return of Donald Trump 2.0, because Donald Trump has basically said that he wants to impose 60% tariff on Chinese imports into the United States on top of what is already been imposed. So definitely the Chinese will have to come up with measures to counteract that. And I think one of the tools that it could use is to lower their currencies, to lower the value of the RMB, and then on top to stimulate the local economy to turn to actually generate domestic consumption rather than export. So this could be some of the things that we could be looking at in the coming months itself. And over in Australia, we are seeing interest rates. The Reserve Bank of Australia has been very, very careful. In fact, they have been behind the curve relative to all the other major central banks. We can see that most central banks has actually cut rates, and the Reserve Bank of Australia is probably one of the very last. They have yet to decide when they want to cut rates. I think at the end of the day, they are fearful of reigniting inflation, which we are already seeing in a lot of places, including the United States. And of course, we're going to spend some time to talk about that. Last week, we see the release of CPI numbers and PPI numbers. And of course, we're going to be talking about that as well. Okay. And in Germany, we can see the harmonized index of consumer prices. There's no surprise here. It came in at 2.4%, very much within expectation. In fact, the number has plateaued. Okay, however, it is not rising, so there is a good news. But also, we are not seeing a dip in the harmonized index of consumer prices, which is the inflation gauge, which is commonly associated with inflation in Germany. Here we can see in the US, we can see CPI numbers month over month, which is the chart on the left. We can see the headline numbers has actually bumped up from 0.2% to 0.3. So definitely we are seeing a re-acceleration of domestic inflations in the United States, whereas the core CPI, which is minusing the food and energy component of the headline CPI numbers, is currently flat at 0.3. This is the fourth month in a row in which we are seeing the core CPI month over month stays at 0.3%. But what is more alarming is the chart on the right, which is the consumer price index year over year. We can see that headline numbers, which is represented by the dirty green line here. We can see that it has been bumping higher from 2.4% 2 months ago to 2.7%, which is a sign that inflation is resurging in the States despite the cut in interest rates. So we can see that the timing of the Fed pivot to cut rates has actually ignited the consumer prices in the States. So definitely we're going to see some kind of reaction to that. Will the Federal Reserve continue to stay continue to cut interest rates going forward? That remains to be seen. But I think the Fed chairman, Jerome Powell, has actually hinted that he may actually slow down the rate cut in view of the elevated inflation that we have seen over the last 2 months. Okay, so again, this will bring forward the idea that in the coming days itself, on 17 and 18, the Federal Open Market Committee will be meeting for the last time in 2024 to decide on interest rates. Market participant has more or less built in or priced in a 25 basis cut interest rate, bringing the total Fed fund rates from current 4.75 to 4.5%. So this is to where we are right now. If that is the case, then we, of course, we will see the Fed fund rate coming down from a high of 5.5% to 4.5% by the end of this month. Okay, so this is something that we want to watch. But going forward into 2025, that will be a totally different story. Whether the Fed will be cutting interest rates, I think right now the possibility is that they will slow down until inflation is more or less controlled. Okay, so in Canada itself, we see what we have been seeing in Canada. We can see that the Bank of Canada has been cutting interest rates very aggressively. You can see this is a turnaround. Okay, at the beginning of 2023, we can see the official interest rates was at 5%. Now it's at 3.25%. So definitely the Bank of Canada is very interested to resuscitate its economy. We all know that the Canada economy is possibly slipping into a recession, and this explains why the interest rate has been cut very aggressively by the Bank of Canada in a bid to resuscitate the local economy. And over in Australia, we can see the labor report that came in. We can see that the jobs are being created from 12,100 jobs to 35,600 jobs. Market was only expecting 25,000 jobs being created for the month of November, but it came in more than 10,000 above the expectation. Unemployment rates, however, has also come down. We can see that the high of the unemployment rate in Australia was 4.2%, and it has gradually been coming down. For 3 months in a row, we can see that October, September, August, we can see the unemployment rate was at 4.1%. Now it comes down to 3.9%. So this is progress as far as we can see. But Australia is also in a lot of hurt as far as the economy is concerned. Prices remains elevated, whereas the economy is struggling. Okay, so this is definitely a welcome sign that unemployment rate is coming off and there are more jobs being created for the month of November, reversing a trend that we have seen in the past month itself. Here we have the Eurozone. Again, central bank interest rates has been cut. The European central banks cut both their main refinancing operation rate from 3.4% to 3.15%. This is within expectation. And the other key rates that they also cut was the rate of deposit facilities from 3.25% to 3%. So we can see central banks this week, or rather this past week, has been cutting interest rates. The one that I'm not showing you here is the surprise interest rate cut by the Swiss National Bank. That one was aggressive. They cut by 50 basis points or 0.5%, which is totally unexpected, which resulted in a loss in the Swiss francs against the other major currencies. So we can see this past week we have 3 major central banks been cutting interest rate from Canada to European Union to the Swiss National Bank. So definitely this is the trend, and we want to see whether will that also cause the United States to also follow through with a deeper cut going in 2025. Like I said earlier on, the prospect is not very bright. I think they are more concerned about holding the line in inflation. Now, this is the producer price index. Now, this is something that we will really have to see because this is inflation at the wholesale level. Producer price index, meaning to say that for every producers in the States, their import costs, whether it is material or whether it's labor cost, has all gone up. We can see that this is the fourth month in a row, and this is definitely one of the highest we have seen, or in fact, the highest we have seen this year. So the PPI is definitely suggesting that retail prices is definitely going to be elevated going into 2025. And if we factor in Donald Trump's imposition of a punitive tariff across the board, then definitely we are looking at the resurgence of inflation going into 2025, and whether the Federal Reserve will actually revert his monetary policy from cutting rates to hiking rates. This is a very high possibility. So we want to monitor this as we go along. Will this have any material impact on equity markets? Definitely so. But what we are seeing this past week has been a little bit unnatural because the numbers are suggesting that the economy is in trouble, especially with the resurgence of prices in the States. But here we are seeing equity markets, especially the Nasdaq Composite and the Nasdaq 100, have all been trading into new all-time highs. But this is, again, later on we will go into the charts and I will show you why it is a little bit unusual, because the data that comes in suggests that US is likely slipping into a recession or may already be in a recession for all we know, but the markets has not been pricing in, okay, the possibility of a recession going to 2025 in the United States. Here we have the Japan Tankang Large Manufacturing Index, which is basically the Purchasing Managers Index. We can see that the index has been doing very well. In fact, showing us that Japan manufacturing sector is doing relatively well. We can see it's at 14, which is the highest we have seen since last year. So 14 is a good number, and definitely we want to see how prices react. And of course, that has also spilled over into the positive outlook for the Nikkei 225, which is the Japanese equity index. Now, going forward, it's going to be a very, very busy week. Okay, we're still going to have many central banks talking about monetary policy, in particular in the United States. But here we can see that we have a bunch of PMIs coming up. Starting off on Monday, we have China reporting the industrial production year over year. They expect it to hold steady at 5.3%. If they can actually do 5.3, which is a very, very good number. However, retail sales is likely to suffer from 4.8 to 4.6%. Earlier on, we did see that the Chinese economy in terms of consumption has actually gone down. So the retail sales is definitely reflecting that situation over there. Then in Germany, we have the manufacturing PMI for the month of December. They're expecting to bump up a little bit better from 43 to 43.8. Now, anything below 50 is a sign of contraction in the manufacturing sector. So right now, the Germany manufacturing sector is definitely underwater, which has been the case for the last 2.5 years. Okay, Eurozone, as well as the manufacturing PMI, we are seeing a slight dip from 45.2 to 50. Again, the entire Eurozone is definitely not doing well as far as manufacturing is concerned. So when we look at Germany, we should be able to see how the various sectors are performing as far as manufacturing is concerned. I think Eurozone as a whole is definitely struggling. Okay, and when we look at the services PMI for Eurozone, we can see that it's also hold steady more or less from 49.5 to expected to be about 49.4. In the UK, you can see services PMI. We don't look at manufacturing because the UK is only strong in the services sector. We can see that it's starting to stay a little bit better from 50.8 to 51. Again, when we look into the United States, manufacturing PMI has no estimates, but we all know that it is also struggling in contraction zone throughout the whole of Biden's 4-year term. He has failed to bring in manufacturing to reshore into the United States. And then, of course, when we look at Donald Trump definitely has a plan, and his plan basically is evolving around imposing tariff on their trading partners in a bid to get them, or rather to incentivize them to actually set up operation in the States to avoid paying the tariff. And the services PMI is also no estimate. Services PMI has been doing a lot better, 56.1, which is definitely in expansion zone. So that is for Monday. On Tuesday, we have the UK labor reports. We have the claimant count change. People who are out of jobs are claiming, how many of them are claiming for social security benefits from 26,700. They expect a number to go up to 28,200. Unemployment change, no estimates here, but the last number that we know in in November was 219,000. Unemployment rates, no change here, expected to be elevated at 4.3%. So unless the numbers get a lot worse, the sterling will come under pressure. And over in Canada, we can see the consumer prices as far as the Bank of Canada is concerned. There are two sets of number here. One is by the Bank of Canada, no estimates, is currently at 1.7%. And then the headline CPI numbers, also no estimates. The previous number was actually 2%. Retail sales is going to be a big number for United States come on Tuesday night. We have retail sales month over month expected to bump up to 0.5 from 0.4%. Now, the control group, which we take out a few sectors, has no estimate, expected to stay negative at maybe perhaps negative 0.1%. And then in the later half of the week itself, we have CPI numbers coming up from the UK. All has no estimates. Previously, it was 0.6% on a month-on-month basis. Year over year, is likely to stay very close to 2.3%. And then the core, which is minusing the food and energy component of the CPI numbers, is likely to also stay around 3.3% where it was for the month of November. On Thursday, we have the big one, which is the FOMC, the Federal Open Market Committee interest rate decision by the Federal Reserve. They expect, market has already priced in the possibility of a 25 basis point cut, or what we call 0.25% interest rate cut from the current 4.75. And if that comes to being, the market will be looking at this, what's going to be the Fed decision going into 2025. That is the big if, because nobody really knows how the Federal Reserve will react under the new Trump administration, because it seems to be the administration is at loggerhead with the Federal Reserve, and we will have to see. I think sparks will fly during Donald Trump's second term between the Federal Reserve and the administration. Then we have the New Zealand gross domestic product, the GDP numbers quarter on quarter for Q3 expected to slide even further into recession from negative 0.2% to negative 0.4%. So we knew that the New Zealand economy has already slipped into recession, and this explains why major central banks are busy cutting rates. Okay, so the only outliner here is Australia. Australia has not cut interest rates yet, and if we want to look at New Zealand economy, I think sooner or later, I think the Australian will also have to follow through, because their economies, although not similar, but are intertwined. Okay, so we can see that the GDP numbers quarter on quarter is likely to slip further into recession, and the year-over-year number expect to maybe improve a little bit, but it's still in negative territory from the negative 0.5% to negative 0.4%. Then again, we have another major central banks deciding on interest rates. The Bank of Japan interest rate decision, no change is expected, although market has more or less anticipating a interest rate hike. Now, Japan is going the exact opposite. You can see that the Japanese economy has not seen elevated inflation for a very long time, purely because they has been in the deflationary cycle for the last 20-30 years. So they are very keen to see inflation coming back, and if they do see the inflation remains elevated, then there will be the excuse to actually hike interest rates. This will have a profound impact on the Japanese yen exchange rate, and also that will spill over into the yen carry trade. We all know global fund managers has been using this very successful strategy of borrowing in Japanese yen and taking those proceeds to reinvest in other markets, including the Japanese equity markets. So if the Bank of Japan do high interest rates, you can see an unwinding of positions from those managers who have previously borrowed in yen. Okay, because yen become more expensive, the trade may not be viable if the Japanese interest rates rises. Then of course we'll also be hearing from the Bank of England again deciding on interest rates, and no change expected here. The current interest rates at 4.75%, exactly the same where the United States interest rate is right now. Okay, GDP for US, this will be the last reading for Q3, expected to stay stable at 2.8%. So if there's no change to this number, then obviously it will be a non-event. However, if this number is lower than 2.8 or higher than 2.8, obviously markets will react. Now, to round out the week itself, we have UK reporting their retail sales. Month over month, they expect to turn positive. Previous month in October, we can see was negative 0.7%. Now, for the month of November, they expect it to bump it up to 0.4%. Now, to round out, we have the last important numbers, which is the core personal consumption expenditure number. This is the inflation number that the Federal Reserve do focus on, and we want to see whether inflation can be tamed. Now, as far as this is concerned, if we use a CPI as a guide, it is very likely that this PCE number, which is the personal consumption expenditure number, can also be elevated. But here the expectation is that month over month, we should see, we're expecting a dip from 0.3% to 0.2% for the month of November, whereas the year over year, which is the more important data set, has no estimate. Currently is at 2.8%. Now remember, the Federal Reserve targets at 2%, and I think it is getting increasingly difficult and very evident that the inflation is not coming down any further. So that is setting the stage for the monetary policy going into 2025. And this is where we are right now. Now let's go into the price chart. Now, if you have any question, don't be shy to actually put your question into the Q&A or into the chat box, then we can address them as they come. So what I'm going to share with you is actually the price chart from the IronFX platform. So again, as usual, I will start off with US equity markets. Okay. Now let me show you the weekly time frame, because there's no point showing you the daily, the monthly just yet. Now this is the weekly time frame. Okay. Now, meaning to say each single bar here represents 1 week of trading activity, and the high traded was actually 3 weeks ago in the Dow Jones Cash Index. The high traded was at 45,078. Last week, we do not have a new high. This week, we can see the market closed on a weak note. Now, we can see over the last 2 months or so, the Dow has been leading the US equity market higher, and the fact that we have quite a bit of a weak closing in the Dow could be setting the stage for profit taking. And if this result in a steeper profit taking into the remaining days of 2024, that could actually be seen to be a pullback. Technically, the market is very, very bullish. However, it does not warrant you to trade counter trend just yet, unless you can see some signs that the Dow is actually coming off. Okay, so now we return our attention to the daily time frame. So this is the daily time frame. Okay, so we can see there's a counter trend in place. You can see practically every day for the last 2 weeks, we have seen the Dow Jones Industrial Average basically been coming down. So we definitely have a counter trend in place in the daily time frame, and whether or not that will result in a trading opportunity remains to be seen. Now I have been mentioning, I believe, for those who have been following me, especially during my presentation to Charles Schwab in the middle of last week, I have been showing the possibility of a divergence. You can see the prices are getting higher and higher from the previous peak, whereas the indicators have not been following through. So we are definitely looking at something like a possible correction that is unfolding right now in front of us. Now we go down to the 4 hours time frame. This is even clearer. We can see that the correction has already started, and whether or not it will be able to give us a bump up, I think this market is likely to do what we call a three-way pullback, initially targeting this level at 42,849. Okay, so any kind of high, any kind of a bounce, especially if it bounce back 50% of its entire decline, it could be a good place to actually consider doing a counter trend trade. Okay, so if we have something like this, for example, this is the, let me expand this chart here. So this is the entire decline. If we have a 50% 50% rebound from where the market was trading as of Friday, then there is a possibility that we can actually join in the selling. Okay, now this, the 50% mark, which is the entire distance traveled from 45,075 to 43,765. The midway point here is 44,420 basis the CFD contract. So this will be a good level to consider if the market can bounce, okay, especially in the three-way bounce, then this could be one area to consider, okay. So this is the Dow Jones. Let's take a look at the S&P 500, which is more retail orientated. So here we have the S&P 500. Again, we will start off by looking into the weekly time frame. So we can see that the weekly time frame, the market has come very, very close to a important chart point here, which is 6,115. Market highs is just under 6,100. So we can see there is no evidence that the market is looking to come back down just yet. Even if it does, I think it will be a correction. So based on the weekly time frame, the market is obviously very, very bullish, with the possibility, if the Dow Jones correction continues to develop, it may actually take the S&P 500 along with it. Here we look at the daily time frame. This is the daily time frame. You can see the daily time frame. You can see there is no evidence of a counter trend just yet. Okay, there is one very minor one. Okay, if you consider this to be the start of a correction, this is a very, very minor corrective pattern on the daily time frame. So this is the start of that corrective pattern. Okay, so there is sign of a very tentative counter trend in place, but it's very, very shallow. It means that do not sell the S&P 500 when you look at how shallow the corrective pattern has been. When we look into the 4 hours, we see something better. Yes, there is a counter trend, but it is very, very tentative. At most, I think we do a 3-wave targeting 6,000 levels, and whether it can do more depends on how the market reacts going forward. But definitely do not sell the S&P 500 just yet. Now, the Nasdaq 100, which is the major equity index in the States right now, is exhibiting a totally different kind of a reaction. We can see on the weekly time frame that the Nasdaq 100 is at a record high on last week. So now do remember, among the major equity index, this is about the only index that have registered fresh all-time high. So this market is currently very, very strong. And it's no surprise because, you know, everything surrounding NVIDIA has been underpinning this tech sector here. So in the Nasdaq 100, it is very much focused on tech stocks. This has been very, very bullish. So I do not see any possibility of a correction just yet, at least not evident in the Nasdaq 100. This is the daily time frame. You see that the market high is at 21,884.9. No sign of a corrective pattern just yet. But again, when we go down to the lower time frame, like the 4 hours, for example, can we see some kind of correction? There is a very tentative corrective pattern, okay, but it is still very tentative. By and large, I would not want to be selling this index just yet. Right now, the weakest links appear to be the Dow Jones. So take the lead from the Dow, okay? Then when we look at the other equity index across the Atlantic, there are a couple of questions here. Let me see what are those questions. Jockey is asking, is the correction in line with the Martin Armstrong to watch out for the last 2 weeks of December? Actually, Martin Armstrong, if you're following his blog, he is saying that the market is a little bit weird and to be very careful into the last 2 weeks of December. I think what he's trying to say is he's hinting of a possibility that the market may be performing, will be performing normally. But he is not telling us what he sees. Okay, so he just asks us to be basically inform us to be very careful going forward into the last 2 weeks of trading in December. That means next week and the week after. Okay, next week it's going to be a shortened week because of Christmas. And across the geopolitical front, we are seeing a lot of signs which is not necessarily healthy. We knew last week that Syria has fallen, or rather the government of Syria has fallen, and now there is a lot of infighting among the component forces that, especially the rebels, now they are fighting each other, and things are not well in the Middle East. But what is more concerning is the latest news that I see here is that Germany is actually planning to send 800,000 NATO troops, including US troops, into Ukraine. 800,000 troops is almost equal to the fighting forces of Russia in Ukraine right now. So if Germany actually deploy, or rather NATO deploy 800,000 troops into Ukraine, it will quickly descend into chaos. Okay, and that could be the what I call it, the black swan. So do look out for development in Ukraine. Definitely with less than uh, slightly over I think about 35 days from today all the way to January 20th. It is still an open question whether the incumbent Biden administration is going to make life difficult for Donald Trump when he comes back again. So I think the stage is being set for an acceleration in the war in Europe. And we are also hearing that the US has sent 3 carrier groups into the Far East, currently stationed in Okinawa and Guam. Okay, and the French also send their only carrier group into the Pacific, and UK is also sending another carrier group into the Pacific. So things are looking to be quite uh, 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 quite unstable. Okay, and China has actually closed out their airspace and the waters surrounding Zhejiang and Shanghai. So not sure what they are doing, but it definitely is not a good sign. So this cryptic message from Martin Armstrong saying that the market is behaving weird and to be careful for the last 2 weeks of December could relate to something like this. We do not know, okay, but be very, very careful. Do not take up new position just yet, and definitely do not be on the buy side, okay? Right. If there's any other questions other than this, let me see. There's no. Okay. Thank you very much, Jockey. So we'll continue. We will look into into Europe itself. When we look into Europe, definitely we want to look into the FTSE 100, which is the UK stock index. Here we have the weekly time frame. We can see that the equity index has been struggling. It has been struggling for quite some time now. Okay, for months, the high has not been revisited. The high traded so far this year is 8,477.3, and the market has been basically in consolidation. And this could be part of a distribution because if the fundamentals are not right, the risk is to the downside, not so much to the upside. Okay, so do watch out for a severe move in equities markets in Europe. Okay, the UK market is definitely one to be looked at. As far as the daily time frame, I don't think there's going to be any material difference. The consolidation is very obvious here. Okay, where prices is right now is definitely in favor of selling rather than buying. Honestly, because like I say, this brown area is the area in which selling does offer us a low risk, high reward trade setup because the fundamentals are telling us that UK is already in recession. So if you take it as such, then there is a good prospect that if there's going to be any sell-off or a severe correction, it will probably come from Europe, okay, in particularly UK. So I won't go further into this because the market is basically sideways and I'm favoring selling rather than buying. And when we look at German index, this is the DAX. Okay, when we look at the weekly time frame, this is the one that is really, really weird. Okay, Germany economy has been struggling for the good part of 2.5 years, but you can see the equity market has been rising. Okay, so this is something that I want to be also be watching. Right now, there's no sell signal just yet, but if there's going to be a sell signal, I'll be more inclined to sell Germany, UK, and perhaps even France. Okay, so look into the equity index in Europe. I think most of them are definitely trading at unrealistic levels. The market here does not conform to the fundamentals as far as the economic data is concerned. So there is no sign that the market is coming off just yet, but it is something to watch. If the market do turn around, especially once the market gives us a sign, then definitely we want to be selling this market rather than Wall Street. Okay, because as far as the G7 is concerned, the US economy is the strongest right now, at least on paper. So they are not the weakest. Always sell the weakest, buy the strongest. But if there's going to be any weakness, I think it's most likely going to come from Europe. Okay. So again, there's no sign that the German index, despite their poor fundamental, is getting ready to topple just yet. Okay, this is the 4 hours. You can see that there's still no sign of a counter trend in place. But you can see the ADX has been climbing down very, very sharply. Okay, so there is a possibility a top is already in place in the DAX, but again, we are not seeing it in the price chart just yet. The other market that you can also consider if you're interested into European equities is to look at Euro stocks. Now, this is again a index makeup, a combination of both French and German listed companies. Again, it is no longer near the, it has not broke into an all-time high for quite some time now. So the high traded so far is 5,001 trillion. That was months ago. Okay, so we can see that this was actually traded in March of this year. So for the last, what, 8-9 months, the market has not been able to challenge this all-time high. So that is to me a sign of weakness. So again, this is again telling me that Europe is not doing well as whole. Do we have any kind of selling signal coming in just yet? The market did go back into this pink color area, which is a area of low risk, high reward trade setup possibilities. Anywhere between let's say 5,000 to 5,001 is definitely more favorable to selling rather than buying. Okay, so if you are adventurous and you want to take a negative view on equity markets in Europe, this could be this could be one index to look at. Excuse me. Now let's take a look at the 4 hours. Is the 4 hours conforming? Is giving us any idea? Now the 4 hours, if it goes back to 5,000 again, will offer us the opportunity. 4 hours to 5,000 to 5,060 will be a good bracket to sell. Okay, in my opinion. Now let's take a look into Asia, where we look at the Nikkei 225. Okay, Nikkei has again been struggling. Okay, it has gone up, but we can see that prices do not have the momentum. Prices has been struggling to go higher. But again, if there's going to be an interest rate hike by the Bank of Japan, this thing may unravel big time. Okay, we saw a big jump down from 42,519 all the way to 30,400 levels. This is a big jump off the cliff. So most likely, I think this pattern does not suggest that it's over yet. If there's going to be another sell-off, I think this low here that we saw at 30,400 may be taken out. And if it does take out the 30,259, the entire structure of this will turn from positive to negative. So watch out, because this is the weekly time frame. So this level is going to be very, very important. If there's going to be a major sell-off, this level must hold to maintain the bullish outlook on the weekly time frame. The daily time frame, let's see the daily. So this is the daily. We can see daily right now, where it is right now is actually very conducive to do a speculative short position. So this is the counter trend. Even if we are wrong, the risk is not very high. So I would think that this could be a good prospect, if you are going to be selling the Nikkei 225. Okay. Right. We'll go over to Hong Kong. Now, this past week itself, we have seen market participant has been eyeing what the Chinese government is going to roll out. The market is already highly anticipating some kind of a stimulus package to be rolled out to support the Chinese economy in terms of equity markets, in terms of the property markets, and also to actually reduce, to cut interest rate further, and to also reduce the bank reserve. So this is all done to actually to stimulate the local economy. So the market has actually been in expectation of some kind of an announcement. So far, there has not been any clear direction, but market is expecting. We can see the market has been rallying off late. Although this is the weekly time frame, the market has come off from 23,265. So this week alone, you can see there was an attempt to rally, but unfortunately, it cannot hold on to its gain. There is big hope that China may actually take out the bazooka and actually launch a very a very substantial or significant cost stimulus package. Here you can see the daily time frame. The overall trend is undeniably bearish. We have that three-wave rally here, okay, from the low of 14,777 all the way to 23,264. So you can see this happen in the three-way, which is not conducive for the bullish outlook. So it definitely can only be seen as a corrective rebound within the bear market. So this is definitely a new pattern. We want to see what will come out of this. If this high is taken out, then there's a possibility of a bigger, much bigger three-wave rally. But again, this will be the mountain to climb. Okay, the market cannot reach 23,600, no, 23,264, then it will be big trouble for the Hang Seng. Right now, there is no trading opportunity as far as I can see in the Hang Seng just yet. Now we move on to the other markets. Is there any other question? So there's no new question here. I will move on quickly to the currency markets. Now going forward, the dollar has actually rebounded. So we can see clearly in the major currency pair. Let's say we go into the euro dollar. So euro dollar has come off. Okay, we can see that I've been buying. I bought too early. Market didn't go up. So I expect a little bit of reaction after all the ECB have already cut interest rates. So the downside risk has been eliminated, so to say. Okay, so I bought 2 times into this, and prices is in between my entry prices. So we want to see how this thing can perform. But by and large, you can see that this counter trend is likely to be not over yet. There's a possibility we may be looking at higher prices beyond 1.1275 going forward over the next few weeks and months. Okay, so there's a possibility that this market is undeniably bearish. So what we are seeing here is a corrective rebound, which I think is not over yet. Okay, the low here should not be exceeded. You need to say that this low at 1.0324 should be able to hold at least in the near term. However, if the price do slide below this level, then of course my outlook is wrong. Okay, so here we look at the daily. Okay, so this bounce here does not look over yet. Okay, there is a possibility of an extension higher, but I don't think it will go as high as 1.08. Okay, but I think I'll be happy with a three-wave rebound, possibly at 1.07 plus. Okay, that will be good enough for me. I will look to exit this a very short-term trade. So as far as the other currency pair is concerned, let's take a look at sterling. So this is the weekly time frame. Sterling has been under pressure. We can see that the market has a rebound, and this rebound is also on paper, it does looks a lot stronger than the rebound in the euro versus the dollar. So we can see by and large, currently the sterling has been under a bit of a pressure on the weekly time frame. We can see that there's a possibility we may see further losses, especially how it closes this week itself. It closes on the lower end of the trading range for a week. Here we have the daily time frame. This is a daily time frame suggests that we probably will see lower prices going forward. Okay, so prices will not look attractive until it hit 1.21. Okay, so for a time being, I will have no position, but if the price do slides all the way down to 1.21, again, it will open up buying opportunity. For now, there is no trading opportunity in this currency pair. Now, the other one that you want to also consider is the dollar Swiss. Remember, the Swiss National Bank unexpectedly cut interest rate this week. Okay, so we can see there was a reaction to the downside, but this was also quickly covered up. By the end of the week, we can see that the dollar versus, this is actually showing weakness in the Swiss franc. So because of the unexpected interest rate cut by the Swiss National Bank, it make it favorable to the dollar. Okay, so overall on the weekly time frame, the dollar Swiss maintains its overall bearish outlook. And in the medium term, in regards to the daily time frame, you can see that the market may be trading higher as far as the dollar is concerned. So we will likely to see further weakness in the Swiss franc relative to the dollar. So that will be actually be conducive for an extended rally in the dollar versus the Swiss franc. So however, once price gets into the area of, let's say, $1, for example, be very, very careful. Okay. Now the other markets that markets are also concentrating on will be the dollar versus the Japanese yen. So we can see the dollar remains elevated this week. There was that sell-off in the dollar in expectation of the Bank of Japan's hiking interest rates, but we will know for sure this coming week itself whether the Bank of Japan will be cutting interest, will be hiking interest rates. The market has already decided it's not going to happen, so the dollar has been bought up, and let's see what happens. The higher traded is 156.75, and if the market can go, if dollar yen pair can go up to 157 half onwards, it will start to look very attractive to do a sell rather than buy, because remember 162 yen against the dollar is that line in the sand whereby the Bank of Japan has proven that it would intervene very aggressively. So this was that move when the Bank of Japan actually intervened in the currency markets by selling the dollar for yen. Okay, so if the price goes back into 157 half onwards, okay, it begins to look very attractive to be selling rather than buying. There's another new question here that I see. Hanvi is asking, when are we expecting the Chinese stimulus to be likely announced? Now, I think it's logical because Donald Trump will only be inaugurated on January 20th. So I think the Chinese are keeping the powder dry. And they want to see whether Trump actually go through with his threat to actually impose 60% tariff, or rather an additional 60% tariff on Chinese export into the United States. I think the Chinese will only roll out the bazooka after Trump has moved into the White House again, and we will have to wait for Trump's next move. Okay. Interestingly, Trump has actually invited Xi Jinping to attend his inauguration, something that has never happened before, because it's a all presidential inauguration has always been a domestic affair. No foreign dignitary has ever been invited, but Donald Trump actually invited Xi Jinping to attend his inauguration, which I think the Chinese has declined. So I think they are not on the best of terms. I think Trump is trying to see what's the reaction, and now I think he knew that he's not very well liked, and we will have to see what happens next. Okay. Now we continue to look into dollar yen on the daily time frame. Daily time frame. Yeah. Now, as the dollar yen is picking up pace again, okay, the individual bars traded on the daily time frame is not particularly concerning to me, although it has been mostly up one direction for the whole of this past week. Anywhere between 154, upper end of 154, nearer to 155 will start to look very, very attractive. The most recent high here was 156.75. So maybe this level will be tested again. So long as if it does not break 157, 158, I think the market still have a chance to actually trade downwards. Okay, so again, watch out for possibilities here. Now, dollar Canadian is another one. Now, the Canadian economy is not doing well, so logically that will put a base under the dollar versus the Canadian dollar. So you can see that the dollar Canadian has been one-way street. There is no counter trend in the weekly time frame. So it does suggest that versus the US dollars, the Canadian dollars is definitely on the back foot. This will continue to be the case because between the United States and Canada, Canada seems to be struggling economically speaking, especially now that Trump has actually threatened to impose a 25% tariff on Canada. Okay, so that will actually invite more sellers in Canadian dollars. When we look at the daily time frame here, you can see there's no counter trend as well. The high traded this past week is 142.45, and there is no incentive to be trading counter trend just yet, because all the fundamentals suggest that the dollar will continue to gain ground against the Canadian dollars. All right, the currency pairs are out. Let's take a look at the commodities. Now, we want to look into, let's say, this is the spot gold. We can see gold has traded to a high of $2,726 and then sold off. Now, this is as good as a pin bar that you can see. The market actually traded to a 4 weeks high before being sell off, and this development here suggests that we are likely to see a three-wave pullback. I've always mentioned that the correction in gold is not over yet. Now, with this week's development from a high to the almost losing all its gain within the week itself, they have set the stage for lower prices in gold. So if this is a three-wave, assuming the high is at $2,726, then the possibility of the market going lower to at least test the $2,480 is actually quite high. Okay, so anywhere between $2,400 to $2,480 could be where the market may finally settle. And this is, if it's a three-wave, then it is opening up the possibility for those who missed the rally in gold to actually look for levels to get into the game. Okay, because overall the trend in gold is undoubtedly very bullish. This is the very bullish market here. Okay, for those who miss out buying, uh, another opportunity, another opportunity can open up. Okay, and that will possibly last all the way, for all I know, into ideally into March. Okay, earlier on I did mention that if the market for the Wall Street, if it closed higher relative to the November high, okay, if December ends on a high note, the market will extend higher, okay, before we see any kind of meaningful correction. But again, if there's going to be a correction, the overall market sentiment seems to be still very bullish. If there's going to be any correction, according to Martin Armstrong, look out for a bottom in March. Okay, so it all depends. If the market closed lower than November high, then the market will straight away goes into a correction, which will last all the way to March of 2025 before we see a market rebound again. Okay, and for all we know, if the market trades into new high and traded above the November high, then it will extend higher, much higher, before a correction will unfold all the way into March. Okay, so the timing of this probably will be in sync with the equity markets in the States. So if there's going to be any corrective pattern in the gold market, ideally we want to see one happening at bottom in March of March 2025. So gold market is definitely very strong right now. This is again the daily time frame. You can see that if there's going to be a three-way pullback, this level is going to be where I think the market may finally settle. Okay, $2,468 at the bare minimum. This will be a three-wave equality move. Actually, no, I think there is going to be a correction here. Coming up here, it's going to be $2,472. Okay, no need to split hair. If there's going to be a pullback, this could be a good target. Okay. Now in the silver market, we can see silver. Silver has a miserable week this week. Okay, whereas we see that the rally attempt, silver also have a rally attempt, but it closes lower than the opening for the week. Okay, so this is definitely a much weaker market compared to gold market. So this is also setting the stage for lower prices with target at about $26.46, at least in the weekly time frame. So in the daily time frame, let's take a look at the daily time frame. So this is definitely a lot clearer. If I do a three-wave pattern here, I think it's safe to say that we are looking at something like 55, 66. Okay. The target will be somewhere around $27.12. So if this is going to be a three-wave, the target is going to be about $27.12 to as low as challenging these two low here, $26. So if we're going to see a $26, it'll be a bonus, okay? Because overall, silver market is also very bullish. So for those who have missed out buying gold and silver, this pullback could actually present a buying opportunity in the medium term. The other market that also, as far as commodity is concerned, we can see that oil prices. Okay, I've been bullish on oil for quite some time now. I have long position. So as far as the weekly time frame is concerned, this is about one of the strongest closing in a weekly time frame for the WTI, which is the West Texas Intermediate crude oil. You can see it closed on the high end, above $70 per barrel. And this could set the stage for at least a bounce, okay, to challenge this high here at $83.90. Okay, so a three-way bounce could possibly target this high here. which is the $83.92. So and anyway, looking at the prospect of what's happening in the Middle East and what may possibly happen in Ukraine now that Germany has planned to actually deploy massive amount of troops into Ukraine, that could actually cause a rally in energy prices. So this is the daily time frame. Daily time frame is actually very encouraging. Prices coming off from this blue area, which is the very deep retracement on the daily time frame, and this could set a stage for at least a move to the here. Okay, if not at $83.92, it will be at least a challenge of $72.53. So this one does looks like a consolidation. A price above here is where I want to take profit. I want to get out first and observe. Right. I think the major events here is here in the crypto space. As far as Bitcoin is concerned, this we have currently the price move to challenge the all-time high of $104,072. 104,000 is a big number. Uh, there's a lot of talks about how Donald Trump is encouraging building a Bitcoin reserve, meaning to say that there is news that the US over the next 5 years is looking to accumulate Bitcoin on a regular basis to the tune of 200,000 Bitcoins per year, building all the way to 1 million coins, okay, in 5 years. So if that's the case, I think if there's going to be any pullback, it will be bought up, okay, and we are also seeing some kind of news coming up from Russia that may also be looking to build up some kind of a Bitcoin reserve. So if that's going to be the case, it will be underpinning the price of Bitcoin. So as elevated as it is, I think that we are not looking at a high just yet. There's a possibility this market may go all the way to 125,000. Okay, 125,000 could be one immediate level to look at. It's a very nice juicy number. Okay, so if that's been the case, do not chase the market anything beyond 125,000 per coin. Okay, so in the daily time frame, this is the daily. You can see the market right now is in a very deep retracement, but I think the market will take out the 104,000 early this coming week, because the momentum suggests that it has the momentum in its favor and it may be able to take out this level. So again, that magic number in my mind right now is 125,000, because that will be into uncharted territory. Nobody knows whether that will be the case. Okay, because Bitcoin has never been at those prices before. The other market that you will also may be keen is actually the XRP, which is Ripple. There's a lot of news on Ripple of late. Okay, now we all knew that the fact that the SEC commissioner Gary Gensler has tendered his resignation to coincide with Donald Trump's inauguration on January 20th is big news. You can see the market has gone parabolic. I totally missed this move. I was looking at Ripple and across a lot of other altcoins, but I didn't pull the trigger. But now it's a bit too late right now. But there is big numbers in Ripple. Ripple is currently the high trader is $2.91. There's a lot of talks of Ripple going to much higher levels. So if there's going to be a significant pullback and if the risk can be controlled, I think it is worth taking a look. Okay, because Ripple do have use case, and there is also a lot of talks about Ripple getting approval from the New York Financial Services, which actually legitimize this token. Okay, and MasterCard has also been issuing cards based on this token itself. So there's a lot of news surrounding Ripple, and there's also news of late that they are about to launch a stable coin. Now, for those in this space here, you know that the stable coin space is ruled by 2 points. One is a Tether, which is USDT, and the other one is by Circle called USDC. These two has accounted for 90% of the stable coin space. Now, if Ripple do get a toehold into this space, it could upset the balance. That is because right now, the US Treasury has actually endorsed Ripple to be the payment system for US Treasury. So this is big news. So there is that possibility that the Ripple coin could be worth a lot more than what we are seeing currently. Okay, so again, I will only consider buying if the price is right. Okay, right now I hope there is already a three-way pullback in the daily time frame. Okay, did not quite hit equality, close enough. Okay, but I think that is over because the rebound has been pretty sharp. So when you look at the price structure, this bar itself is a pin bar. So if this bar here does not see pullback, there's a possibility the low here is already in place. Okay, so there's no clear low risk, high reward trade setup. Maybe we can go down to the 4 hours. Let me see if it's a 4 hours here. Let me see. Yeah, the market actually went into this area. Three-wave pullback into this area of $1.89. That was it. And the market bounced very strongly on this. So it's very difficult to expect price to come back into this price. But if it does, again, this area here between $1.81 to $2.04 could be one good area to watch to pick up some. Right? All right. Let me see if there's any other questions that you have for me. Now, remember, next Sunday will be the last webinar for this series for 2024. We will come back again in the first week of January. So again, next Sunday will be the last market rep series for this year. Any other question before I knock off? Tomorrow I will be back in I'll be back in KL. So if those of you who are in KL wants to meet up, do let me know. Okay, Elon is asking whether can see Ethereum. Now Ethereum has been underperforming, in my opinion. In the weekly time frame, okay. So we can see that while all the coins has broke into all-time high, Ethereum is far away from the all-time high. The all-time high here is at $4,860.25. So it is struggling with this double top here. Can it break beyond this double top here? The momentum in the other altcoins is very strong, okay, underpinned by Bitcoin momentum here. So it's just much of a surprise that Ethereum has been lagging so far behind. Okay, so if you're looking for a bargain, maybe this is the only place you can find. Ethereum has been underperforming big time. So this is the weekly time frame. Take a look at the daily. Market has actually gone into this area, a very deep retracement level, and it resulted in a pin bar to the downside. So again, something is capping the run in Ethereum. I think the $4,000 per coin has been the psychological levels that it cannot break through. Okay, there are times market breaks above the 4,000 levels. Okay, but it has not been able to sustain anything beyond that. So that being the case, this could end up in a three-wave looking for a new low below the $3,500 per coin. So it does not look that positive on a relative basis. If you are bullish on digital assets, this is not where you want to be. Okay, Ethereum doesn't seem to be the place for us to be able to see elevated price unless something else changes. Okay, so in terms of momentum, there isn't much of momentum in Ethereum, relatively speaking. I think if I have to pick a coin, I think I'm definitely be very interested in Ripple because of all the underlying news that is swirling around this coin. All right, no other questions. I will end the session for this evening, and I'd like to thank you guys for your time. And again, I will see you next Sunday for the last of the series for this year. Bye bye, and Merry Christmas.